The global monetary system is undergoing a period of unprecedented uncertainty and instability. But at the same time, there is an incredible amount of innovation, particularly in the form of digital currencies. How might this evolve into the future? And could digital currencies serve as a solution to unsound money? Well, joining me to discuss this topic today is Rob Price, who is a macro strategist and economist based in Los Angeles. He spends a lot of time studying and observing digital currencies like Bitcoin. Rob, welcome to Solutions with David Ansara.
Great to be here, David. Thank you for having me.
Great, Rob. So before we look at the future of money and some of the big possible potential game-changing new currencies that are out there, I think it's also important to understand the nature of money itself and also some of the problems that our monetary system is facing. So let's start with the first question, which would be, what is money?
Fantastic, David. Yeah, it's great to start at the beginning there. It lays the foundation for why these new technologies are so important. And money is such a badly misunderstood concept. At the end of the day, really, it is a technology. We often think about the outcome, but money is a technology. And one way to characterize the whole technology is societies have chosen many things as money throughout history, and it tends to be the most tradable good. It can actually be anything. And if you jump straight to the examples, you can see how strange and obscure the things can be. And then we can kind of characterize what the similarities are and what the good forms of money are and the bad forms of money, which teases out the principles. Societies have chosen things as obscure as cigarettes as a form of money, or salt, stones, shells, beads. So these things seem quite obscure. But if you think about the context in which they were chosen and the economy and the society and the technology at the time, it starts to, make sense. So for example, cigarettes, they were chosen by people in concentration camps in the Second World War because, they were constrained by the technology available to them, the resources available to them, and cigarettes served a purpose. And the qualities that we often, you look for in money is for them to be scarce, durable, divisible, and transportable. And if you then take those kind of principles and apply them to the examples that we've used, you can see how in some societies those might have been good forms of money. As example, going back to the cigarette example, in that context, those cigarettes were scarce, difficult to get hold of. They're not particularly durable, but if you keep them in a pack, they last for a reasonable period of time. They're of course divisible and they're transportable, right? And then within these other contexts, something like seashells might have been scarce within that society. So it's important really to understand the conceptual framework. All of these goods end up they're tradable and they have some degree of qualities over these characteristics. And over time, societies gravitated towards metals because they're more durable, more divisible. But of course, they can themselves have cumbersome aspects. They can be difficult to transport. They can be difficult to verify. How much have you got? What weight? Is it pure? And that led then to further technological advancements. Where we invented coinage, and coinage is probably the last major technological advancement, if you think about it, with money. But at least coinage then allowed easier verifiability of the money and more divisibility. But even that in itself, once again, had cumbersome aspects. You've got to transport the coins. Where do you store the coins? So that led to warehousing of coins and people issuing then those paper certificates of deposit, which was once again a reasonable innovation. So then you could just carry a lot, your paper money, and that's where we got really paper money from. And that introduced then, though, a lot of human element to the situation, because those warehouses could start to issue more paper than actually they had, coins in receipts. And that would, of course, be, cheating the existing holders, the existing depositors. And we might get onto that kind of, detail in a bit. But it just, I guess, starts to show you how this human element comes into the technology and creates these potential problems. And then thereafter, I guess it brought us to the era of central banking. But I'll pause there, before we get into more detail on the central banking. But yeah, money, it tends to be the most tradable good in society, and it is really helpful to look at the history to understand these principles of scarcity, durability, divisibility, and transportability, rather than just thinking about the outcome of the money that we use today.
So, Rob, I mean, another way of thinking about currencies is that it's a medium of exchange, it's a store of value, it's a unit of accounting. And, I think it's very easy to take money for granted. You open your wallet and there's the money. But underpinning that is also the need for trust and faith in the value of that money. And I think what I'd like to do is also just tease out this concept of sound money and understanding what that is. How do you know that the money in your wallet is trustworthy, is worth the value that you presume it is?
Yeah. So, I mean, with government issued monies, they are, we have legal tender laws that, only a certain currency can be used in a certain jurisdiction. So, by decree, governments ensure a degree of trust in their money. But, whether that money is sound or not is another matter altogether. And a simple description of, maybe before we get onto sound money, what is unsound money? Well, an unsound money is a money where there is very little constraint on the quantity of new money that is created. So there's very little scarcity in that money. And that really characterizes most of the monetary and financial systems that exist today, where governments turn towards unsound money policies, which would be lowering interest rates, issuing of more debt, whether it's by themselves or encouraging households and corporates to issue debt themselves, but using new money as a supposed solution. I put that in inverted commas because, I mean, as we'll go into the details, it's not a particularly good solution, but over the short term, it seems to work, right? You print up this money, you use it to appease the problem that you're dealing with, whether it be a social problem, an economic problem, a financial problem, a political problem. But there are consequences that come out over time. And so a sound money, of course, would be one that is sound, that where the money is actually scarce, where you have greater trust. And I guess the really big problem here is that, distrust only finds expression over time. You don't immediately distrust in money because a government has lowered interest rates. The consequences are quite abstracted, and they only find expression kind of slowly over time. I mean, obviously it depends how extreme the unsound policy is, but most unsound policies take, stepping stones towards being unsound over time. So we don't, we don't lose the trust immediately, and as a result, the government doesn't feel the pinch of our lack of trust very quickly.
And yeah, I mean, I think throughout history, there have been some very dramatic examples of when trust in money breaks down because of government interventions or other economic conditions. Weimar, Germany, Zimbabwe, I think it was in 2008 with their hyperinflation crisis. So what are some of the drivers of this unsound money? How does it come about? How do we get to this point where the soundness of money deteriorates?
Yeah, and I mean, coming back to your examples, which are great examples, and I'm glad you brought those up. I think it's important for the audience to note, though, that everybody's on a continuum. And often when we're trying to explain things, explain a concept or an idea, we go to the extreme, which makes sense, going to those extreme hyperinflation scenarios. But all countries are in some degree of continuum, of how unsound their money is. It's just, at the absolute extreme, it's very obvious to see. But you asked, how does one kind of get there? Well, it is, by using the types of policies that I've spoken about, where rather than trying to actually face up to a social, economic, political, or financial problem, you think to yourself, okay, well, let me just kind of take the easy solution. Let me try and paper it over with cheap money. That really is the principle of it. At the extreme, what happens is that, governments have very little practical financing, through tax revenue, and they're actually going directly to the central bank to print up money and use that money to pay for their expenses. But once again, as I said, that's in the extreme. All governments are somewhere on this continuum of using low interest rates to try and create inflation, which makes it easier for governments to repay their rising debts, which are issued in nominal terms, and inflation helps them to repay those debts. And so, we're all kind of in countries that are actually faced by this unsound conundrum, and we all are facing the consequences of the unsound money, even if we don't see it come through in hyperinflation.
So, Rob, you mentioned earlier the role that central banks play. So when we're talking about governments, central banks as an institution obviously playing a critical role in controlling the money supply. But the institution of a central bank is actually quite a new phenomenon. It's really only since the beginning of the 20th century that we've seen central banks emerging. So what role do you see central banks playing in all of this?
Yeah, and maybe coming back a little bit to our monetary history and linking these together, and they come together quite nicely. The major reason offered why central banks were created was to prevent the banking crises that emerged when you had private banks issuing money, because the way that those private banks would be disciplined by the market is that if they issued too many certificates of deposit, which, as we said, was kind of cheating their existing deposit holders, eventually that would result in some inflation, right? Because you'd have more paper money relative to actual commodity money and coin. And when the market sensed that, they would kind of have a bank run on the private bank, and that might force them to, go under, which would actually be it would be volatile, but it would be a good correction mechanism, because the bad banks would go under and the good banks would continue to exist. So central banks came along and they said, okay, well, this is volatile, and governments often try to do this, right? They wanted to kind of reduce volatility. So they said, okay, well, we'll create a lender of last resort to prevent bank runs. That was kind of the initial the reason that they offered. I do think it's important to know that there is actually potentially another reason. If you look back through the history, and there's a great book to read on this, Lords of Finance by Liquid Ahmed. It's quite an interesting book. Don't worry, it's not a kind of economic textbook. Quite a thriller of central banking through the years. But he talks about how, and he shows quite neatly how banking became increasingly centralized over many hundreds of years. And actually the key time where it became particularly centralized was around wars. So when governments go to war, they need to finance that war. And they could, of course, get some tax revenue from people who are willing to pay, but people are only willing to pay so much tax to see their people go to war and send people out to be killed on the battlefields. And so it was easier to rather go to banks and say, okay, well, you get us a loan. The population will only see the impact over time through inflation. So we'd rather just, use the debt to pay for the war. And it was but if you're going to all individual private banks, once again, it's a negotiation that you have to enter into, which is a challenge. So what they did over time is they would give increasingly kind of monopoly rights to certain banks, bestowing on them certain privileges, so that when the time came that they needed to get funding for their wars, that they would be able to have that good relationship. And listen, I'm not saying it's the only example. I've given kind of the the PC example of the banking crises. But if you look through history, it's actually very interesting how the centralization of banking did take place, particularly around wars, and throughout Europe. That history is true with the Bank of England, the Bank of France. So anyway, those two reasons, I guess, brought us to this day of having central banking, where they control the monopoly over the issuance of money.
So that's the history of central banking and a bit of a potted history of money itself. But let's look closer to today. And I think since the global financial crisis of 2008, 2009, we've really seen a fundamental disruption in the financial system. And I think what's so striking is just to see how much stimulus has been pumped into global capital markets, and just how low interest rates have been kept for so long, whether it's the Federal Reserve in the United States, where you are, or the ECB in Europe. What are some of the consequences of this in terms of the way in which we use money today?
And just also to add on into your question, you said obviously the US, the ECB, and if you look at South African interest rates, they actually follow the same correlation as the others. It is slightly higher, but they're also at a record low. So getting on to the consequences, there are numerous. And listen, I'll try and keep it short because I don't want to talk about the consequences forever. But it's really important to note that there are numerous consequences to these unsound monetary systems. The authorities tell us that the only consequences is CPI inflation. Which we see the CPI index, which actually tends to be reasonably low, but that is not. It's not true that is the only consequences. There are numerous consequences to this creation of money, and hopefully, conceptually, you've already seen that when new money is created, that dilutes the existing shareholders of the money. The existing shareholders of rands get diluted when new money is created, and so it benefits the people who get their hands on that new money, right? So one of the key consequences here is the unequal consequences, the unequal outcomes, that the people who get their hands on the money first get the benefits relative to those who don't. And I'm not trying to say that there's kind of a particularly nefarious intention here, or trying to make some kind of conspiracy theory whatsoever. It's just a matter of fact that the people get their hands on the money first benefit. And you see the consequences very clearly in the world that we live in today. We've got some of the biggest governments that we've ever seen, right? Because they get their hands on the money first. We've got some of the biggest financial sector that you've ever seen in the history of the world. Once again, the financial sector gets their hands on the money ahead of the rest of the population. And we're also dealing with a lot of inequality in the world today, because richer people get access to funding via private bankers and so on. So as I said, I'm not trying to make any sort of conspiracy theory here, and I've got nothing against people becoming wealthy and going after wealth. And I also don't think that we should target equality as an outcome either. Equality in the world is always going to exist. But the problem here is that we've got a mechanism at the center of a financial system that enhances inequality. Inequality, bigger governments. Another key consequence is weaker economic growth, because as the economy becomes saturated with debt, the economy actually struggles to function as well as it should. We're not allocating capital efficiently because the pricing mechanism is incredibly distorted. Money starts rushing to all sorts of new fads, which aren't necessarily particularly valuable because of this distortion in the money. And that actually, as I said, impacts economic growth. It impacts job growth. So it impacts, every man on the street. And then I guess the last one is a little bit more esoteric, but I think it's really important, is that I think it impacts trust in the economy, right? When you have these price signals that is distorted, when you're living in an unequal world, when you're living in a world with lots of government, with lots of power, but they're not really seeing the results in economic growth, we just live in this world of distrust. And I think people can feel that. And as I said, it's difficult to walk through some of these relationships because they seem quite abstract, but hopefully now that I've kind of walked you through some of them, you can understand how there's actually many nefarious consequences, or maybe nefarious is the right word. There are many negative consequences to us, and many of the problems that we are dealing with, and we do talk about these problems, but we very rarely talk about the relationship to the unsound monetary system that we live in.
Okay, so there are a lot of negative externalities. There's capital misallocation. There is asset inflation, and all that benefits the existing holders of assets. All right, but you've underscored the importance of scarcity when it comes to a currency or to money. But there's a new form of digital scarcity that is being offered by new technologies, specifically cryptocurrency. And I know in your writing, you focus a lot on Bitcoin. Could you tell us how these new forms of currency have emerged and what problem they are seeking to solve?
Sure. I mean, I guess the first point to note is that people have been trying to create a digital form of money, ever since the internet emerged. There's many fascinating quotes of famous economists, Milton Friedman, a very well-known economist. I can't remember exactly the year, I think, in the 80s or the 90s, talking about the potential for the creation of a digital money. So people have been working on this idea for many years, and they struggled. It's a very difficult problem to solve. To create digital scarcity is very difficult. If you think about it, in the digital realm, we don't really have scarcity. Everything is kind of abundance. On social media, shopping, phones, electronics, we just have this abundance of information, particularly in the digital realm. You can just create more and more and more. And in fact, many computer scientists became quite fatigued with the idea of creating a digital money. They didn't think that it would ever then in 2008, 2009, Satoshi Nakamoto launched this, was first sent out a white paper to a cypherpunk mailing list, and created Bitcoin, which started as a completely hobbyist idea on people on this mailing list, but it obviously has grown exponentially over the subsequent years. But they managed to solve this problem of creating digital scarcity. And I would describe Bitcoin as three things. And there's lots of different frameworks to think through it, but maybe to summarize, it is three things. It is one, it has solved this digital scarcity problem. It is a digital store of value. And the way to think about it is actually quite similar to something like gold. The way that gold is difficult to find and difficult to mine. And even if gold, the gold price were to increase from where it is today, around $1,800, if it were to double, you can't increase supply of gold very easily, because you've got to find more mines, and mines can only produce so much. So it is a scarce asset, and gold functions as a store of value over long periods of time. It holds value. It can be volatile over the short term, but gold does. If you look at the return history, it actually competes with many equity markets, many property markets, and it has a very important role to play in portfolios as a result. But anyway, the point just being that it's a good way, if one can understand gold, and unfortunately many traditional investors don't have a good understanding of gold. But anyway, and then we can get onto the consequences for Bitcoin too, because it gives us a good lens into understanding why many traditional investors don't understand gold particularly well. But anyway, I was talking about the three main characteristics of Bitcoin. It is this store of value, and despite the fact that Bitcoin itself is even more volatile than gold, it does store value over long periods of time. So it has solved this digital scarcity problem. Second, it is a digital payments network. Because it is on the internet, it is truly borderless. I can send money to you in South Africa. I can send somebody to somebody and send money to somebody in China today. It is this borderless payments technology, which is pretty incredible if you think about it. If I want to send money to you in South Africa via the banks, you have to go through all these intermediaries, pay money, and wait time for that to be executed. Sometimes you need to get even approval. And I was trying to get Bloomberg paid for the other day, and it was I was cut off from Bloomberg because Saab needed to approve the payment This is it's pretty incredible. But anyway, so Bitcoin is a digital payments network, which is pretty powerful. People can now transact borderless. One of the initial use cases for Bitcoin was to send remittances across borders at much quicker and cheaper rates. And then the third one is, once again, a little bit more conceptual, but I think is an important framework, is it because Bitcoin is a store of value and because it is a payments network and it doesn't rely on intermediaries, it is like an independent system of property rights itself. It doesn't, you don't need to go to a judicial system to adjudicate on who owns what on the Bitcoin network. The Bitcoin network tells you who owns what on that network. And so it is its own ecosystem that is developing entirely. I mean, of course, it is related to the traditional financial system because capital flows in from the outside, but it doesn't rely on the external financial system whatsoever. It is its own independent system. So that is kind of, I guess, the three principal ways to think of Bitcoin.
All right, Rob. Well, one of the things that I've observed about Bitcoin is that many people are taking a buy and hold strategy. They're kind of long on Bitcoin. So they're definitely seeing the store of value. But the actual transactions, as far as my reading can tell, are actually, the volumes are quite low, that the transaction speeds are often quite slow. And because most people are taking a longer term view on Bitcoin, it's not actually being used for day-to-day transactions.
Yeah, great point, David. So this gets, I guess, into the understanding of what Bitcoin is trying to achieve. So to create a completely independent store of value, it requires the technology to be very sound and to run particularly effectively for long periods of time, and for the principles to be well guarded. And so the principles of Bitcoin being decentralized and having a very clear constraint on the supply are more important than the actual transaction fees. And what the Bitcoin community has decided over time is to elevate those relative to transaction fees, because those are more important. Like, there are ways to transact on Bitcoin at cheaper fees by using second layer solutions, and some of those aren't all as perfect as we'd like them to be yet, but there are ways that one can transact on the second layer at cheaper cost. As an example, if we're on the same exchange, we can transact with each other at cheaper costs. Or if we use different technologies like Lightning, as an example, that is a second layer solution that allows us to transact at cheaper costs. So don't get me wrong, those technologies have room for improvement in how to find ways to transact at cheaper costs, but there are ways to do it. On the base layer, the choice has been to prioritize decentralization and affirmation of the constrained supply, because if one starts to kind of compromise on those to get cheaper transaction fees, that might risk the whole project altogether. And there's a great history that one can read up on if you're interested in the kind of the block wars debate, where there was a big friction in the community because some people wanted to focus more on payments, which is a logical argument to make. They said, listen, Bitcoin needs to be digital cash. We need to be able to transact at cheap costs. And they wanted to increase the block size of the blocks that are processed every 10 minutes. But as I said, there were risks to centralization. There were risks to the what the impact might be for the future monetary policy. And so that there's a trade-off there. And so hopefully you can understand that the trade-off implies that at the moment the community has decided that to prioritize the scarcity of the network and the decentralization and create cheaper transaction fees on other layers. And it's, I guess, last point to note here is that, Bitcoin is still incredibly useful, even though transaction fees aren't as cheap as you might like it to be. It depends what you're using it for, right? If you're using it for high value transactions, well, then you're not too concerned about the costs. And if we're envisaging potentially, and we might get onto the where to for Bitcoin in the future, but if you're envisioning the potential that Bitcoin can actually become the center of a new financial system, then you're not going to be using that technology to buy a cup of coffee. You'll be using other technologies. And if you even relate it to the world that we live in today, the technologies that we have for buying a cup of coffee are already pretty good. Credit cards and debit cards, and in America, Venmo and Zappo and all these technologies, they're pretty good for cheap payments. The problem that we have with our payments technologies is more actually the scarcity. And so you can understand then why the community has prioritized scarcity and decentralization over cost of transaction fees.
So I've heard some commentators say that cryptocurrencies and Bitcoin today is sort of like how the internet was back in the early to mid 1990s. That it's this new technology, but the kind of second generation technology that developed on top of that was really how the value of the internet was unlocked, and that there's a parallel to Bitcoin today, that you might get these additional protocols that might be bolted on to how we trade or how we do daily transactions. But that it's more important to focus on the underlying foundation of money and the scarcity aspect that you mentioned. So one of the things I'd like to just pick up on is the volatility of Bitcoin. And we are recording on the 13th of May, and Elon Musk has just announced that Tesla will no longer accept Bitcoin payments for their motor vehicles, reversing an earlier decision that he announced. And the price has now plummeted. And, this just seems every week there's some kind of spike or dip. And it's quite bemusing to look at this market and think, well, is this what the future is going to look like in this brave new Bitcoin world? So what are your comments on the volatility aspect? Is that just a short-term thing, or do you think that might even out, or do you think that will just be a permanent feature of the Bitcoin market?
Yeah, maybe just also a quick one on Elon Musk. I think Elon Musk is a good example of why it's not good to hero worship. Elon Musk is obviously a smart guy with lots of interesting visions of the future and is a hero to many people. But he says all sorts of different things, and he can change his mind about things from week to week. He also has been promoting a coin like Dogecoin, which originally was created as a joke. So I don't take what he says with too much importance. But yeah, coming down to the volatility question is an important one, and there's a lot that can be said. The first important point to note is that you're merely seeing volatility on the price. The actual technology is not changing at all. It is very stable. Bitcoin's principles don't change at all. There will only be 21 million. There are blocks mined every 10 minutes. The network reaches consensus on the position of the network. So it is actually a very stable, non-volatile technology itself. What is volatile is our interpretation of the technology and how we price that technology. And it very much brings in the human element. And one idea that I like to offer to people to think through this is that, the process of Bitcoin adoption or monetization or whatever word that you want to use is a psychological process. Because as I've said, the technology is not changing. The principles are intact. It's about how we digest those principles and say whether this has value to us or not. And obviously humans are very prone to different ideas. We have we can have very volatile emotions and understandings of something. And it's not a particularly easy technology to wrap your head around. There's all sorts of fields that one needs to get a grapple on, from economics to computer science, to politics, and then to even trading. Because I guess what you're talking about is on the price comes down to the trading. So anyway, but there's all these different fields to wrap one's heads around this technology, and it particularly stumps many traditional financial people, because their traditional valuation metrics, which are often very accountancy based, traditional investors approach financial markets and say, okay, well, what's the growth? What's the yield? What dividends am I going to get? And these are powerful frameworks. I'm not poo-pooing them. These are valuable frameworks, but they don't work in the Bitcoin realm. Bitcoin doesn't have a yield. It doesn't, you can't see what the earnings growth is and what dividends are going to be paid out. It is a constrained supply asset. As I said, it's got the similarities to gold, and many traditional financial investors also don't understand gold particularly well. But anyway, the point that I'm just making is it's difficult to understand and it's difficult to value. So that is a challenge for people. And then combined to that, we are living in the most unprecedented time from a monetary perspective, with zero interest rates, massive amounts of debts, quantitative easing, your stimulus checks from the US government on a quarterly basis. This money is being thrown into the financial system, and volatility is high in traditional financial markets generally. If you look at the VIX index, the US equity market index, if you look at the volatility of Tesla, there is a lot of volatility out there. So, yes, Bitcoin is volatile, but as I said, it's mostly our kind of interaction with it, and it is in the context of this very volatile financial world. And I guess maybe just an additional point to make here is, maybe two additional points to make here. This is a very powerful technology that is monetizing from like zero worth in 2009 to 13 billion in about 2013 in terms of market cap, to 240 billion 4 years later, to now 1.1 trillion. So, did you expect that to happen in a straight line? No, there's going to be a lot of volatility as one grapples with a technology that potentially could, change the world. And then I guess that last point that I just wanted to note is that if you look at the volatility of Bitcoin relative to technology startups, like something like, Amazon, 10, 20 years ago, or Apple or Google, these stocks were very volatile in their early years because they were powerful technologies that people were grappling with, trying to get their heads around. When Amazon or any of these companies started, similarly, to your point about new technologies, there are lots of doubters. This thing has no value. Who's going to use this? When the internet came out, people said, who's going to use letters over the telephone? That sounds like a ridiculous idea. So who's going to use this magic internet money? Why do we need that? But over time, we grapple with these ideas. And of course, there's still lots of doubters out there. There's plenty of doubters out there. But over time, people start to understand the technology. But yeah, all these different concepts lead to a very volatile interaction with a very powerful technology. What I would just encourage listeners to do is to, understand these concepts, but also pull back the lens and say, okay, well, over long periods of time, it is going up. It's going up by astronomical amounts, and not because I'm trying to give a sales pitch in terms of your buying, but just in terms of the power of the technology. I've stated to you the numbers of how the market cap has grown. That is far more important than the volatility that's taking place below the surface.
So, Rob, where to from here? And I think what's fascinating to me are the political economy aspects of this discussion. So, countries with fragile economic systems that might be able to pivot towards a digital currency like Bitcoin. And naturally, governments around the world have not ignored this new trend. And there are some regulatory concerns, some government actions that are maybe pushing back against the adoption of these currencies. What are your thoughts on government's role in all of this?
Yeah, the thinking through the government role regulation is absolutely fascinating, because it really incorporates a lot of game theory. So there's a number of different things that can be said. I mean, the first point to note is that this is a technology on the internet, so it is very difficult to ban it. It's not impossible, but it is very difficult. Like, it's very difficult to ban the internet. What are you going to shut off the internet? That's not very likely. So, I mean, the way that the phrase that I like to use is you can't really ban Bitcoin. You can only ban yourself from Bitcoin. Like, if you were to actually institute a ban, Bitcoin still exists on the internet and continues to run. So, and at the extreme, governments, of course, could ban it, but look at the success that a country like China has tried to ban Facebook before. People just access it via VPNs. So I mean, historically, we know that government bans on things don't work particularly well anyway. Even in the traditional world, I mean, in the past, the US government has tried to ban alcohol during the prohibition, and that didn't work particularly well. We have a long-standing ban on drugs, the war on drugs globally, and these assets. These substances are still used. So it's very difficult to ban things. It's certainly very difficult to ban a digital asset that people can access via VPN. In the US, it's even it's possible that Bitcoin is protected as code under the First Amendment as free speech. So it might actually even be impossible in a place like the US to execute a ban. But that being said, once again, let's take the next step. Well, it doesn't mean that the governments, I'm not saying that governments can't do anything. That's not true. Governments can obviously do things. So what could they do? Well, they could try and kind of ban exchanges, or they could, implement more stringent regulations in their country to try and slow down adoption and make usage of the technology more difficult. But one has to ask the question, so why would they do that? And what would the consequences be of doing that? In the US, if the government were to come out and, ban the big exchanges like Coinbase and Gemini, what would that happen for? What would the impact be on innovation? What would the impact be on jobs of those people? And would the government want to would pass up this technology and say to everybody else in the world, okay, well, you use this technology, but we're not going to use it over here. In South Africa, once again, there's companies that have, jobs in South Africa, Luna and Valor. These are very reputable companies that are running. So, and you see this in action. There's some great speeches from, US lawmakers. Hester Pierce is a good one to look into. She's the commissioner of the Securities Exchange in America, so a very reputable individual. And she said it would be foolish for governments to ban Bitcoin because it's just not really practical. So, what you end up seeing is that the freedom-loving countries, they just kind of let the technology run to see what happens. And then at some point they see a lot of activity and they say to themselves, okay, well, certainly at least SARS and the IRS in the US, they say to themselves, okay, well, there's a lot going on here. How do we get our tax revenue, please? And that implicitly starts to create more legitimacy, right? Because if you ban something, you can't really tax it. And at the other end of the extreme, you do see some countries coming out with more negative regulation. So as an example, Nigeria has tried to stop Nigerians from withdrawing from their cryptocurrency exchanges to their bank accounts. And in Turkey, the government tried to stop merchants from accepting cryptocurrencies for payments. But in those countries, the people already understand the value of these technologies. They've already experienced the negative consequence of a weakening currency, the naira in Nigeria, the Turkish lira in Turkey, weakening currency over many years due to bad economic policy. So when those governments implemented those more negative regulations on Bitcoin, what happened is that there was more activity in Bitcoin. So the people just basically not completely ignored what the government said, but it certainly didn't detract them from using it. In Nigeria, local Bitcoin activity went through the roof. Local Bitcoin is peer-to-peer activity in Bitcoin. And in Turkey, they were still allowed to use the exchanges. So people started buying more Bitcoin. So I use the phrase that if you think your government is going to ban Bitcoin, then you need it more than you think. Because by the time your government has come to a point to ban a technology, which is a freedom-loving technology, there's nothing nefarious about this technology. If you get to that point, then you have more things to be worried about than the idea that government has banned the thing that you hold. In fact, you'd probably want more of that thing that you hold, than you already do. So there's a lot of game theory to think through here, and basically you're seeing the world, in a sense, I guess, split into these two parts, where a lot of countries just kind of let the technology progress and then start taxing it, and so it implicitly legitimizes it. And the more authoritarian leaning who are grappling with trying to ban, but it not being effective whatsoever.
So, Rob, none of us know the future, but we can certainly try to position ourselves for the future and study very closely the trends that are developing in front of us. But as a final thought from you, how do you see the evolution of Bitcoin and other cryptocurrencies developing into the future, and how might our financial systems be changed by it?
Yeah, as you said, I mean, I'm no Nostradamus, so I'm not going to say that I know exactly what the future holds, but I think there's a few key insights to share here. And the first one is that, Bitcoin is potentially equivalent to previous technological revolutions of the past. And hopefully, this conversation provides that context for you, that we've obviously gone through the technology itself, but also the context of the world that we live in that is very unsound. This is a problem. It is the problem, the way that I see it. I mean, unsound money is the challenge of our lifetime, certainly in the next 5 to 10 years. Numerous of the consequences that we are living with in society are actually impacted by this central monetary problem that we are faced with. And now we are faced with a technology that could potentially solve that. Now, listen, of course there are risks. I'm not saying that they're not risks, but hopefully you can see the clash of a problem and exciting technology. And so pulling back the lens once again to previous technological revolutions, like the internet, which has changed society in ways that we couldn't imagine when it first started, or things like the steam engine, the spinning wheel, the printing press. These technologies fundamentally changed society, and we couldn't imagine it, all the impact at the start. Like, as an example, the steam engine was invented to enhance productivity in factories. It ended up seeing transportation of goods over long distances, and then eventually humans, leading to mass migration of society. So, I mean, people, of course, did not predict that on day one, and how that changed society is quite dramatic. So we don't know exactly what the consequence is going to be of this technology, but I do posit that it will be profound. Bitcoin and the rest of the ecosystem is creating a new financial infrastructure, and this will change, people's lives in quite profound ways. And what I do know for certain is that the people, the families, the communities, the businesses, the societies, the cities, the countries that adopt this technology, and I would say it's even more than just kind of Bitcoin, it is the principles of sound money. When people adopt those principles, they feel the positive benefits from being less consumption focused, being more savings focused, being more long-term focused. We live in a world that is highly consumption-driven, short-term focused, where people aren't planning for the future. We're spending like all our time just rushing around in the short term. Well, I do see these impacts, and you speak to people who have adopted a sound money. Believe me, their actions start to change. Where they start to, when your primary asset is an asset that's going up in value, you don't want to spend frivolously. You want to save and invest for the future, because there's a more positive future when that asset could go up in the future. So that just kind of gives you a personal example. And then maybe one practical example is, if you think about the specifics of how this technology is changing, people are now using Bitcoin as a primary collateral in their financial transactions. And this is a very exciting concept, something that I've been speaking to my friend Chris Becker about, who I know you also know. This is a very interesting change that can develop in the future, because at the moment in our current financial system, we use property largely as our collateral to get business loans and to get loans for new property transactions. And we can envisage a world here where if your money manages to hold value over long periods of time, you might no longer be using those assets as collateral. You might actually be using your money as the primary collateral. And so that can completely change the way the financial infrastructure is set up. And as I can't think through every last way that is going to find expression, but hopefully just thinking through that example can help you realize that the world can change in quite profound ways over the coming years. So as I've said, I think that people who adopt the technology will feel those benefits, and they will be more prepared to handle the volatility that I think will kind of continue to ensue in the world around us.
Well, Rob, thank you very much. And I think on your website, soundmoneymacro.com, you document these very exciting changes, and it is at the same time a rather daunting time to be looking at and observing our monetary system. And I certainly hope that some of the technological opportunities and changes that you've described certainly come to fruition. Thank you very much for joining me on Solutions with David Ansara. It's been an absolute pleasure. And where else can people go to find your work and to learn more about the things that you're interested in?
Yeah, so Twitter and my website are the two main places. On Twitter, I am sound_money. And then, my website, soundmoneymacro.com. You'll find my contact details and email address there.
Rob Price, thank you very much.
Thanks, David.